Hello, my friends. Today is December 30th, and this is Markets Weekly. Now, this week was a pretty quiet week in markets, but there are still some interesting things happening. On Friday, year end date, we saw the RRP participation spike to over $1 trillion. And if you were looking at repo rates on that day, you also noticed that repo rates were elevated as well. But taking a step back, we'll see that this happens on every year end date and sometimes on quarter ends and month ends as well. Let me explain to you why this happens and why it's nothing to worry about. Secondly, I want to take a step back and see how markets have performed over the past 2 months. I think what we'll see is that markets have basically just been one big trade. And like all trades, nothing goes in a straight line. Now might be a time to be a bit more cautious. And lastly, let's take a look at the latest inflation numbers and see that it looks like the Fed is basically right on target, but let's also talk about the prospect of inflation reaccelerating later next year. Okay, starting with the reverse repo facility. So on Friday, year end date, we saw RRP take up spike to over $1 trillion. But if you look at a historical graph of RRP participation, you also notice that it basically spikes every year-end date and sometimes on quarter ends. And if you go back a few years, you also notice that it spikes on month ends as well. So why does this happen? Well, at a high level, this is just balance sheet window dressing. So banks at period end dates like month ends or quarter ends and year ends sometimes adjust their balance sheet to make it look better to regulators and to investors. And that adjustment has real consequences to markets because at a high level, balance sheet is basically the availability of financing. So when the banks have a lot of balance sheet capacity, that means they have a lot of capacity to provide financing. And when they shrink their balance sheets, that also impacts the availability of financing as well. Well, actually, bank balance sheet constraints are such an important part to understanding markets. I have a separate free online course on my website on the topic, and I'll leave a link in the description below. So let's walk through an example. Let's say that you're a hedge fund and you want to borrow $1 billion to make an investment. So you borrow $1 billion from a bank. On the bank's balance sheet, it records $1 billion asset loan to hedge fund. That's all great. But the thing is, a bank's balance sheet is limited in its capacity. It can't provide infinite amounts of financing. The exact limits on a bank's balance sheet is going to differ from bank to bank, but it's largely going to be influenced by regulation. So during the Great Financial Crisis, before the Great Financial Crisis, banks had very limit on their balance sheet capacity, and so they basically made a ton of loans. And then when the loans did not turn out well, the banks went bust, and we got a huge financial crisis. So after 2008, regulators put a whole bunch of rules on banks that really constrained their balance sheet size. It becomes more costly for them to expand their balance sheet. There's a whole lot of rules on this, so it's the constraints are really going to differ from bank to bank. But however, the way that these constraints, these regulatory constraints are calculated, really depends on jurisdiction and it depends on the rule. For example, in some countries, these constraints are calculated based on what the bank has on their balance sheet at the end of the month. In other jurisdictions, it's calculated differently. And for some rules, they're actually calculated exactly on what the banks have on their balance sheet at the end of the year. So among all the calculation dates, the year-end date is going to be the one that banks care most about. One, of course, basically everyone is going to have to be calculating a lot of ratios based upon their year-end date. And also what's on their balance sheet on year-end is also what shows up on their annual report, which the shareholders look at. So the year-end date is a very important date for banks. So they want to be able to, usually what happens is that they'll shrink their balance sheet a bit so they don't look as levered as they otherwise are. So on this date, then, banks have less capacity to provide financing. So this actually is actually really interesting. Because if you look at narrowly on the repo market, again, this affects bank balance sheet constraints affect all markets, but since we're talking about the RRP, we're talking narrowly about the repo market. So that means that on year-end date, banks have less capacity to provide repo lending. Now let's take a step back. Now, usually when the bank is providing repo lending, where is it getting the money? What it's usually doing is it's borrowing from a money market fund and then taking that money and relending it to a hedge fund. So when the banks are doing this, it's called matchbook repo trade. They're borrowing from someone and they're lending to someone else. It's a pure intermediation trade. So in this context, balance sheet you can think of as the size of a pipe. Money is basically flowing through a bank's balance sheet to get to someone else. Now, when the bank's balance sheet is being constrained, let's say on year-end date for reporting reasons, then that pipe narrows. And logically, it has two consequences. Now, the people who are lending money to the bank, well, they're not going to be lending as much because the bank doesn't want to borrow as much. So those guys who are lending money to a bank, they got to do something else with their money. Now, the second consequence, of course, has to do with the people who are borrowing money from the bank. Well, the bank is not lending them as much money as it was before, so those guys, they're going to go and find money elsewhere. And this actually perfectly explains what happens to the repo market on year-end date. So the banks shrink their balance sheet, less intermediation. So the money market funds who are lending to the banks, well, they're not lending as much. So what do they do with their money? They go and they place it in the reverse repo facility. And so we see RRP participation spike on year-end dates. And so those hedge fund guys who are borrowing from banks, well, they're not able to source as much financing as they used to. Say they go to borrow from somewhere else, maybe from smaller banks who are not as regulatory constrained. But in any case, the total amount of financing available to the hedge fund community is less than before. And when supply and demand, less money available for lending means higher interest rates. So you see repo rates spike on these period end dates. And that's all that happens on these special reporting periods. Now, what we'll see after the passing of year-end date is that this will quickly revert. And so RRP participation will come down and repo rates will come down as well. Now, in the past, we've also seen these constraints show up on month-end dates, but again, it really depends on a lot of moving parts and the regulatory changes that have been occurring as well. So this is really something that everyone expects, and it doesn't really mean anything at all. But it is an interesting thing that shows you how market structure impacts market pricing. Okay, the second thing I want to talk about is just what's been happening in markets over the past 2 months. Now, let's take a step back and look at interest rates. So we can see for the past 2 months, the 10-year yield has declined precipitously. Now, it seems like the catalyst for that decline was the quarterly refunding announcement, where the Treasury seems to suggest that they're going to be issuing more bills and fewer coupons than expected. And that spurred a rally in the US Treasury market. And of course, in the weeks following, we had Fed officials who began to signal that maybe they might be thinking about pivoting. And so that poured more gasoline on the fire. And so rates went down even more. So over the past 2 months, we've saw the steady decline in the 10-year Treasury yield to levels that were prevailing. Well, actually, if you look back, it looks like we are where we started a year ago. And interest rates, of course, are tremendously important in determining asset prices. Let's look at another chart here. This is a chart of the US dollar index. And just as interest rates have been declining, the dollar has been selling off. Makes perfect sense, right? As interest rates decline, the dollar is not offering as a compelling yield as it used to, so perhaps people don't want to hold as many dollars compared to other currencies as they used to. And of course, a dollar selling off, interest rates declining, that eases financial conditions, and we see equity markets, the S&P 500, basically going up like a rocket ship over the past 2 months. Again, a lot of things happening in the markets, many moving parts, but at a high level, this seems to be like the one big trade that has been driving everything. Now, if that's the case, though, we also got to think, well, are rates going to continue to decline? Well, I think that's getting a bit difficult to say because right now, if you look at markets, it seems like they're pricing in six interest rate cuts next year. That's pretty aggressive. Maybe they're right, maybe they're not. But at a high level, when we look back historically, nothing goes up in a straight line. So when we see these tremendous moves in market prices that go in straight lines, we got to be a bit cautious. Doesn't mean it's not going to continue, but it does mean that sometimes, usually, what we see is some digestion, either sideways or a counter trend rally. So when I look at this, it seems like it's time to be a bit more cautious. Again, it doesn't mean that the rally is over, and as all you guys know, I'm very bullish on the S&P 500 going forward. But when we have these tremendous moves in markets, it just seems wise to be a bit more cautious. And okay, the last thing that I want to talk about is inflation. So when we look at the most recent inflation data, we'll see something that's pretty interesting. So on a year over year basis, obviously inflation is still above target. But when we look at inflation for the past 3 months, for the past 6 months, what we see is that inflation that is, looking at those numbers, basically already on target. Now, does that mean the Fed's mission is accomplished? And so all these rate cuts being priced into the market, is that the right policy choice? Well, before we go there, I think it's helpful to look at a chart of inflation in the 1970s and 80s, which was the last inflationary period that we had. So as we can see, inflation went up and then it declined significantly and then it reaccelerated. So there's always that prospect. And I'm sure when inflation went down at that time, everyone was thinking that the inflationary spike was over and mission was accomplished. So we got to be careful when we look at this. And it's helpful to think about just why inflation declined to understand whether or not it will potentially reaccelerate again later next year. So there's a lot of theories going on as to why inflation declined. And I'm sure the Fed will be eager to take credit, but when you look at it, it doesn't really seem like the Fed's interest rate policy had a big impact on declining inflation. Now, the Fed was thinking that they would hike interest rates, cause a recession by slowing down interest rate sensitive sectors, and we saw some of that. But at the same time, we saw GDP growth continue to be strong, home prices continue to increase, stock market continue to soar. So it's hard to attribute a lot of this disinflation to what the Fed has been doing. A lot of it actually seems to be improvements in the supply chain that, again, inflation is just supply and demand. And when you have increased supply, then prices come down. And so a lot of it doesn't seem to have much to do with what the Fed did in their interest rate policy. And that again leads to the next question. Now then, if interest rates are declining and a lot of the disinflation was not due to the Fed's interest rate policy, does that mean that inflation could reaccelerate? And that's an interesting question that I talk about in my blog post this week, where I think that, yeah, I think that inflation has a good chance of reaccelerating again later in the year. So before we go and we jump into soft landing territory and so forth, we got to think a little bit about where initial conditions are in the markets. Over the past couple months, we've had a significant easing in financial conditions. And at the same time, the underlying fundamentals of the economy seem pretty good. So there's a good chance that as interest rates decline, financial conditions ease, that we could see a real reacceleration in inflation later on in the year. Now, this is happening during an election year and at a time when I think many people um, are expressing a lot of concern over the objectivity of the Fed. So, how the Fed will react, that's going to be in part a political question. And I think it's not going to be strictly based upon what we see in the economy. Now, I think it's really interesting to note that former president of the New York Fed, President Bill Dudley, who at the time when he was at the Fed was one of the top three most important people in the Fed, actually wrote in a 2019 column in Bloomberg saying that, it might make sense for the Fed to influence the election through monetary policy because he really did not like one of the presidential candidates. And I don't know if there are other people on the Fed who feel the same way today. And so going forward, I think Fed policy is going to be a bit more difficult to predict because there's going to be more of a political dimension. It's not strictly going to be about economics and so forth. So going forward, I think next year is going to be an interesting year. I don't think that we have fully achieved the return to inflation target. And I think there's really big risks that we could see inflation reaccelerate. Okay, so that's all I prepared for today. If you're interested in my thoughts, check out my blog, fedguy.com. If you're interested in learning more about markets, check out my online courses, centralbanking101.com. And have a happy new year, and I'll talk to you guys next week.